The US economy has proven to be much more resilient to more than 500 basis points of interest hike by the central bank. Obviously, interest rate hikes are still having an impact on economic activity. When we look at investment indicators are pointing to weakness coming, and probably households have spent a large part of their extra savings. So we think we'll have some more pressure, but we also acknowledge that the US economy has proven to be much more resilient, especially as regards the employment market. And so we keep an open mind, but we think that further weakness is probably more likely.
The US economy has been much more resilient in 2023 than what we expected, and particularly after the spring, when we saw a deterioration of many economic indicators. And just after that, surprisingly, the economy stabilized, and so it resisted much more than we expected. Can it last in 2024? For us, it's not sure, because first there are many lagging effects with a tightening cycle, and so we think that a certain number part of the economy will weaken in 2024. For example, the residential sector, but also the structural investment and also consumption.
Europe has been weaker than the US. If you look at the GDP, it was basically flat over the last 12 to 18 months, but the unemployment rate stays very low in Europe. The latest economic indicators are pointing to more weaknesses. People expected that after the reopening post-COVID, we would have a burst in growth in China. That did not happen, because China is still going through an adjustment into the residential and building sector. And we think that this adjustment will carry on. So the government is trying to prop up growth with some measures, but there is less room to do so due to the high level of indebtedness in China. Nevertheless, we start to see some impact of this measure, but we should not expect a spectacular increase in growth in China. Clearly, over the last 2 months of last year, the markets have priced the best scenario possible: higher growth and lower inflation.
Last year was a surprise for us with this very strong performance in the equity market, particularly at the very end of the year. We have the impression that the equity market is really pricing the best economic scenario, what they call a soft landing, very slow growth, but not a recession. We think that it's not a done deal, and we think that there is some value in investing in a good quality bonds. We like money market, we like treasury bond, we like also good quality private bonds. What we do not like now, it's the high yield market, particularly in the US. We think the US high yield bonds are very expensive, and that probably, if we have a recession, as we think, we will see a significant decline in this kind of bonds.
Right now, we want to keep a cautious asset allocation into the patrimony funds. We have an underweight in equities. We have a bond portfolio made of good quality bonds, and we are neutral duration, because we think that there are still a lot of questions to be answered. And so probably next year will be a year of more flexibility for the fund.